Hello friends, welcome to Kavita's classroom. Today we'll talk about indirect tax, a very important concept for the students of economics. So let's understand what do we mean by this, why is it imposed by the government, what all are the things, and what is the overall impact of indirect taxes on the society as a whole. So let's begin. Here we go. So when we talk about indirect taxes, what do we mean by these? The taxes where the burden of payment can be shifted to some other person. For example, the example is GST, Goods and Services Tax. Very much clear from the name itself, it's applied and it's applicable and levied on goods and services in the economy. And why are these imposed? Because taxes become the source of revenue for the government. So yes, these generate revenue and these correct the market failures as well. And when I say market failures, what do you mean by the term market failure? As we all know that markets determine the prices and quantity by their interactive forces of demand and supply. But there are certain negative and positive externalities which are associated with some products, like alcohol and tobacco. These have negative externalities. So, government wants that the production, as decided by the demand and supply forces, is higher than required and it should be curbed. So to adjust that very value, government tries to impose taxes so that the production of the goods and services which have negative externalities should be controlled. Right. And hence the prices also should be raised so that there is a curb on the consumption and production of these things. So let's move ahead. When we talk about indirect taxes, these are of two nature. One is specific and other is ad valorem. When we talk about the diagrammatic representation, with the impact of taxes, the supply is reduced, right? But in case of specific tax, the new supply curve moves just parallel on the left side. But when we talk about ad valorem, there is this type of shape wherein we have a V created here when the curve is shifted back. What does it mean? Specific means it's based on some character, like its number, weight, length, or size. On some specific characteristics, the tax is levied. For example, on one wine bottle, the tax is 100 rupees. So it is not talking about which wine and any bottle, maybe which size, which company. It's not at all pertinent here. As and when one bottle would be sold, that much amount of tax, the same tax would be levied. But ad valorem talks about the tax which is on the basis of the value. Right. If value means the price which is paid for that very thing. So as the price goes up, so the tax value comes out to be higher. So for example, though it is 20% tax, but we know at this value, the 20% of 100 rupees is 20, but 20% of 1000 is 200, but 20% of 10,000 is 2000. So when the quantity keeps on increasing, the value keeps on increasing, right? This gap is enhanced. So ad valorem shows this type of structure and specific shows this type of structure where it is parallel and this is giving a widened value of supply curve. Right. Move ahead. If you talk about, say, the car, in specific, it's only talking about number of cars. Like if one car is sold, say 1 lakh rupees, the tax. So if 10 cars would be sold, it would be 10 lakhs. So it's a constant value. But ad valorem talks about 20%, means if a car worth 10 lakhs is sold out, it would give other value of tax. But if it is say 1 crore rupees, it will give the other value of tax. Right. I hope this is clear to you. Now let's move ahead and understand the impact of indirect taxes on market and other stakeholders. So demand and supply, this D curve and S curve create and decide the equilibrium in the society, and price and quantity is decided by this equilibrium, right? So here we talk about this is the basic structure, but when tax is imposed, so S curve, what happens? It shifts leftwards. Right. So what is the equilibrium price? Equilibrium price is increased. So it gets a hike. And what is equilibrium quantity? Equilibrium quantity is reduced. It gets to have a fall. You must understand how much is the tax revenue here. So this is the tax which is put by the government. Now let's understand how do we calculate the tax revenue. This is the quantum of tax. And what is the final quantity now? The quantity is, just keep it down, down, down. This is the new equilibrium and this is the tax, and this much quantity would be traded in the market. OQ dash, right? So what is going to be, so this is going to be the tax revenue. Because when we talk about the area of rectangle, it's length into breadth, right? So length is OQ dash quantity, right? And breadth is this E dash and say K. Because what is the value of tax per unit? So tax per unit is E dash K, this vertical distance, right? So tax revenue is, I'm marking is this P double dash. So this is P double dash K, E dash and P dash. This box, shaded red box, is the tax revenue. Now point is, what is the tax incidence on buyer and what is the tax incidence on seller? This is the whole tax imposed, right? So earlier the buyer had to give this much price, OP price. Now the new price is P dash. So it means this upper box is contributed by the buyer. But because this also is the tax revenue, so this lower box is contributed by the seller because this is overall revenue of the government by the taxes. So tax incidence on buyer would be, I'm naming this point as K dash. Right. So on buyer it is P, K dash, E dash and P dash. But whereas on seller it is, the buyer pays extra incidences, whatever is the amount over and above the previous equilibrium price, right? And other than that, whatever is the tax payment, that's done by the seller. So seller is giving here in this case P double dash, K and K dash. I hope this is clear to you, right? We are done. So by now we have to talk about this as well, that what is seller's revenue and buyer's expenditure. Try and understand. Seller's revenue. You may think that this whole box O, P dash, E dash and Q looks to be the seller's revenue. No, this is not the seller's revenue. Though the seller would be taking this from the buyer, but out of this box, P dash, P double dash, K and E dash is nothing but the government's revenue. This box has to be given to them. So what is the seller's revenue? Seller is left with O, Q dash, K and P double dash. The lower white box is what the seller is going to get because OQ dash is the quantity and double dash is the price which he is going to get with him, right? Because the distance, this vertical distance, right? This vertical distance of P double dash and P dash is the amount of tax levied, right? So what is buyer's expenditure? Buyer earlier had to pay O, P, K dash, O, P, E and Q. But now after the taxes, he is paying extra. So buyer's expenditure is O, P dash, E dash and Q dash. So buyer is the whole big box is what expenditure, the buyer is going to bear, this expenditure would have two components. One goes to the government as the government revenue, and the other goes to the seller as his return of his initiative, right? So let's understand, do we have any sort of deadweight loss or any other component before and after tax? See, before tax, if we talk about the consumer surplus, let's have it. Consumer surplus before tax is this, the distance between the price line and the demand. Right. But after tax, what happens? After tax, see in this other diagram, the tax has reduced the supply curve to the left. So now buyer is giving this price for this quantity. So consumer surplus after tax is this much, and here before tax is this much. Right. So if we talk about producer surplus, so what is producer surplus going to be? Producer surplus before was this, or this is PS, the gap between the price line and the supplies. Okay? Now, what happens after the tax is levied? The producer surplus is only reduced only to this much extent, PS. Why? What's the gap like? What is the gap in this P double dash K, E dash and P dash called? So here we have tried to explain in the previous section also that this box is the government revenue, right? So earlier this whole was the total surplus. Total surplus was consumer surplus plus producer surplus, and that was the maximum value. But after giving this taxation, this much above is consumers, below is producers, and the middle box is the government revenue. So we are left with this triangular region. And what is this triangular region known as? This is called the dead weight loss in the society after imposition of tax. This is dead weight loss. That's why we say that as and when government intervenes in the free market, this reduces the efficiency and perfection in the market structure. So if we talk about before and after the taxation, this highlighted area in blue color, that is the deadweight loss as compared to the previous and new situation. So if we talk about buyer's expenditure here, what's going to be the buyer's expenditure? Here the buyer's expenditure is C, P, O, Q, and E, the whole structure, right? This box. What is the seller's revenue? The seller's revenue is because what the buyer is spending is going to seller. So again, the P, O, Q, and E is going to the seller because this is the quantity traded and it is traded at this price. So this is the situation before tax, right? So quantity and price remain the same. OQ is the quantity, OP is the price. But let's understand what happens to the buyer's expenditures and seller's revenue after taxes. Buyer's expenditure is the bigger box, that is O, Q dash, E dash, and P dash, right? This is the buyer's expenditure, the whole big box, and this is divided into two parts. One goes to government as the revenue, the orange highlighted box, and the other, that is O, Q dash, K, and P double dash. This goes to the seller as its revenue. So point is, this highlighted area, which is untapped, this is the dead weight loss, which happens when the government imposes and intervenes in this free market structure. I hope the things are clear to you. So thanks for watching. Have a blessed day. Bye-bye.